Welcome to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. And today we're talking to a previous guest, Jayanderson, a buyer's agent who recently cleaned up at the Pippa Awards. And we have a chat to him about building a foundational portfolio. What are the steps to getting into a position where you can start really looking at that passive income play? What's the first type of property that he would pick? What's the next one after that? What do the properties look like if we're looking for capital growth, or we're looking for development upside, or we're looking for cash flow? And when should we look for those sorts of things, and how do we consider fitting them into the portfolio? This will be part one of a two-part series where Jay believes the next part after building a solid residential base is to look at commercial, and he's quite specific about the types of commercials that he looks in, and the price point is not something that the average property investor might be able to get into from the beginning. So that residential part is key, and we deep dive on the resi stuff in this episode, which I got a lot out of myself, and I'm sure you will as well. Here's Jay. Jayanderson, welcome back to Geared for Growth.
Thank you, Mike. Always a pleasure chatting, mate.
Well, you know, you say that, but I'm actually planning to make you work pretty hard today. I have this idea in my head about, let's say, a professional person, perhaps they're a couple that is yet to be a property investor, but they own their own home, perhaps with a mortgage, but have at least got some savings or some equity to start their journey. Now, let's assume they don't have the sophistication around, well, this is the passive income that I want to have in retirement or anything like that, but they've got a couple of $100,000 and they've followed your stuff and they understand property investing, and they've read Jan Summers or whatever people do, and they just go, all right, I want to build something chunky that's going to give me some financial security, some freedom to try and design the life that I want rather than being stuck in the rat race in the 9 to 5. How's that for a starting point?
Yeah, throw me in the deep end. Love it. I guess this question comes up a lot, you know, especially with people starting off property investing, and they kind of want to know, well, hey, what I'm actually trying to achieve here. I know I need to buy a property, got a general idea of what I maybe should be buying, but, you know, I want to see a kind of picture of what this kind of look like at the end. So, you know, we often talk about kind of like ideal portfolios. Obviously, you know, each client's going to have their unique circumstances where we might design a specific property for each client. But generally speaking, you know, based on the information you've said, you know, I would kind of typically say, let's aim for the next, 10 to 15 years. Let's try and build out a portfolio. And now let's reverse engineer and have a look at what that portfolio might look like. So typically, I would say maybe would focus on trying to get maybe 3 to 5 residential properties. In those residential properties, we then want to break down and get a little bit more kind of granular on what they look like and what purpose they serve. So in those 3 to 5 residential, we would want not only geographical diversification, but having a look at different purchase strategies with each of those purchases. So this is something that I'm very strong on. So as opposed to just going out and buying 5 very similar types of properties, actually breaking it down and looking at different purchase strategies. So one property might be strong owner-occupier appeal, maybe a bit more of a set and forget, lower maintenance, something that's going to be easy to sell without having to put any money, throwing any money into it. Something like that's always great to have, because if you do need to sell a property, typically those ones are going to be easier to sell as opposed to, let's say, a property that needs to be renovated and circumstances have changed. If you now no longer have the money to renovate it, now you're trying to sell an unrenovated place, obviously that's a lot harder. So first one will be that set and forget, strong owner-occupier appeal, strong owner-occupier market. Second one might be something that's got value add potential. So one of the things we've been doing recently with a few clients is, taking a 3-bedroom, 2-bathroom, 2-car home. So a 3, 2, and 2 might be early 90s style floor plan, dual living areas plus a formal dining room. And we might look at converting that formal dining room into a 4th bedroom. So for not a lot of costs, you're converting a 3, 2, and 2 into a 4, 2, and 2. That on top of some cosmetic reno, great way to kind of add value. For that strategy, one of the things we'll look at is price disparity between unrenovated and renovated properties.
Yep.
And this is where people often fall into a trap where they go, well, hey, we've seen shows like The Block and all the rest of it, and I'm going to go renovate a property. It's really about not only identifying markets that are already earmarked for strong capital growth, but where we've got a big disparity between house prices.
Yep. And that could also be disparity between the bedrooms too, right? Like a 3-bedroom is maybe worth 600, but 4 bedrooms are worth 700. And you're like, well, it's not going to cost $100,000 to change that dining room into a bedroom, right?
Yeah, spot on. And, some of the markets we've kind of been buying in recently with that disparity, you might have entry price into a market at 650, 700,000. And in that same suburb, you've got properties selling at 2.5 million. So
right. There's
a really big disparity. So what's interesting there is, rather than buying a property at 650,000 and the highest property that sale price in the suburb 700,000, and you're battling this kind of price ceiling, where you've got that big disparity, you've already got active buyers in that market with much bigger budgets. Yes. So you can now have a look at comparables and go, well, what's it worth now? And if I was to spend 50, 100, 150, 200, whatever that number might look like, to what kind of standard and condition can I get the property into? And then what are those properties selling for? And where we've got that bigger disparity, obviously that helps.
So we need that. Sorry to interrupt just quickly, but so that disparity is really, really important in the value add one because we're wanting to go from X to Y. So we need a market that has seen those values transact, right? But I want to go back to sort of maybe a bit of the basics is, why is the second one a value add? Is it because it gets harder from a finance point of view? Like the bank's not going to straight away lend you the third one unless you can actually get a reval that outperforms what normal capital growth could do. Is that why the second one you're saying add value?
Yeah, look, and all these properties I'm going to talk about, it doesn't have to be in any set order as well. You can be doing it in any order. It's just when we take a step back and look at the portfolio at the end, how many properties and what types of properties do I want that mix to look like? Mm-hmm. But having the value add stuff is great because, as you said, it can fast track things because you're obviously manufacturing equity can help you get into, the next property faster.
Yep.
Also, as time goes on, and this is another reason why I like building a portfolio like this, is regardless of what your circumstances are or market circumstances are, it's nice to be able to come back to your portfolio and say, you know what, we've had a really good year in the business, got, a bunch of cash sitting there, cash flow is really strong. Why don't we go back and look at doing that value add thing now? Mm-hmm. Or on the flip side, hey, finances are really stretched. We probably need to let one of the properties go. Which property should we sell? Oh, let's go back to that first one. That's going to be easier to sell, own occupier appeal, don't have to put any money into it. Or you might look at that value add one and say, hey, let's do that value add now, dress it for sale, maximize the sale price on it and sell that one.
Yep.
So you can always come back and look and assess which properties, the most suitable to whatever your current circumstances are.
Yep. Love that.
Next property would be, like getting something with development potential. This is always a little bit of a funny one because the way I look at it is, first of all, we want to make sure that the property stands on its own 2 feet and is a good investment, regardless of whether you do the development or not. So that's kind of the first box we tick. And then you might get something that's subdivision potential, something you might be able to knock down, rebuild, something you might be able to do, a big structural cosmetic reno on, like really transform the property. Could be something in a rezoned area that you could knock down and do townhouses on or, units or something like that. But having that development play up your sleeve where in 5-10 years, come back, got enough equity in the portfolio to then maybe do that development.
I'm assuming people would think, well, that makes it hard to tick that first box of it being a good investment that stands on its own feet because you're always going to have to pay for a premium on that upside. So the yield's going to be tricky. Is that a reasonable assumption, or can you actually have your cake and eat it too with some of that?
No, it's a reasonable assumption, and then that probably segues really nicely into the next one of getting a property that's, stronger cash flow. Right. So it might be a house and granny flat. With the granny flats, what I've done in my own portfolio is build granny flats on a steel subframe with lifting points.
Right.
So what that basically means is, down the track, well, yes, it's great for the cash flow now, but when I go to develop that site, we can literally bring a truck in, pick the granny flat up, move it, sell it, do something with it, as opposed to just knocking it down. So it might be that, or it might be a duplex where you're buying both sides, ideally strata titled or can be strata titled. So that's, always an interesting thing, because if you're getting a duplex with both sides, cash flow is stronger yield, 2 tenants, so you can stagger the leases, so the property's always generating some income. And then down the track, you could look at selling one, keeping one, selling both individually, selling both together. It just gives you a lot of more options as well.
Yep. So going back to the beginning, the first one is kind of a set and forget. It's ticking all the boxes. It's got a reasonable cash flow. It's got the upside potential, but we're assuming that we don't have the cash or the inclination to necessarily work on that. Then we've got something that's got a little bit of an X factor, and we might have to sacrifice a little bit of our yield or cash flow across the portfolio to get that, but it just gives us, I guess an anchor at a location where we can come back and something juicy could be done there. But then the next one to perhaps stop you from getting stuck there is a little bit more of a cashy one. Is that a fair assumption? Is that we probably got to that point where we might get stuck at 3 if that third one isn't a good cash flow one?
Yeah, correct. And then going back to what I was saying before, it doesn't have to be in that order. You might go the cash flow one first. The order doesn't really make too much of a difference. It's more tailored to the individual, I guess, person's circumstances on maybe which order you would do it in. And then the next kind of 2, you might double up on, one of those types of properties. You might get another cash flow one if you need it. You might get another value add. You might get another set and forget. And then basically once we've built those 3 to 5 properties, then we'd start looking at commercial property. And that's when we're looking at bringing in a much stronger passive income.
Well, hold your horses on that for a second, Jay, because not everyone lives the high-flying life of luxury that you do. Is 3 enough? Are those 3 quality properties enough for most people? And, the 4th, the 5th, the commercial, these are just people like yourself that like to fly private jets, to brunch in Provence and that sort of thing.
I'll answer the question about property specifically. So I guess, a common theme that always comes up when I speak to people is, what are you trying to achieve with property? The first part of it is normally, build an asset base, some wealth creation, some, overall net wealth. And then it segues into later on of going, and I want a passive income when I want to retire that I can offset my income now and have a passive income to live off. Where that falls apart, where if you're only going to get those 2 or 3 residential properties, is the cash flow part later on. Right. So in order to kind of tick the boxes on what the most common, things are about why people want to build a portfolio, yes, it's the wealth creation, building the net worth, the asset base, and then the passive income. To get the passive income, it's much easier to get from a good commercial property than it is from a massive residential portfolio.
So with those 3, they might be enough in terms of their combined value, but you sort of have to sell them to be able to use that money. And that's kind of counterintuitive for someone that wants to get that passive income. You might get a lump sum, but then it's like, well, there's not really any return on that unless you chuck it in the bank. But this is a way to have that asset base and then transition to the active part of, I get paid $100,000 a year and I want that to come for free by doing nothing except holding these properties. The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah. Or, there's other parts to it as well. That commercial property is obviously going to help serviceability as well, which is going to help if you wanted to grow the portfolio bigger.
Yep.
Or it can help, pretty aggressively pay down the debt on the residential as well. So there's kind of a few different options and scenarios that can suit, a wide range of different people. But that's kind of, in a nutshell, would be kind of the ideal portfolio. And I think it's a pretty good starting point to then be able to get into some nitty gritty and work out some cash flow stuff with clients and work out and start kind of mapping out what that actually scenario would look like.
Before we do go to 4, 5 and commercial, because I'd love to hear your thoughts on those, I'm interested, how much do you kind of insist on people thinking about, say, things like a passive income that they want? Because when you sort of jumped into their shoes, they were talking about building an asset base and some net wealth. Those are just sort of broad things that people talk about rather than very specific. Jay, I actually want to see a cash flow income stream of this exact number. Like, how much do you kind of insist that they go a little bit further, or is it just kind of almost like an intellectual journey and a learning experience for them as they go along?
Yeah, I think it's probably more the latter, in the sense that, if someone's already got a portfolio or they've come from that, an industry or a career where it's very numbers orientated and they've already got their spreadsheets and budgets and all the rest of it. But, for somebody just starting off who's not across that, I think you could drill down and ask all these questions and they won't actually know the answers for. So it's, we kind of want to match it and kind of ease people into it. It's really about, them thinking about, hey, what are they actually trying to achieve? And then kind of just trying to map that out on paper and go, well, if you are wanting to do that, if that's the outcome you're trying to get, the plan that you had won't actually help you get there, which we see that kind of disconnect quite often. Perfect example, I had a conversation earlier this week with someone who had budget of 1.5 million, wanted to buy in Sydney, wanted to buy a freestanding house, pre-approved, and they wanted it to be positively geared.
Probably shouldn't laugh, but I mean that's that is definitely having your cake and eating it.
But that's just that they're not understanding it, and they haven't kind of been given the advice yet on how that doesn't make sense and why it's not possible. And if you were to buy a property in Sydney, freestanding house at that level, this is what the actual numbers would look like. So if you are wanting to get something that's, more closer to neutral or positive or whatever that may look like, this is what the cash flow numbers would need to look like in terms of rental yield. In order to do that, these are the markets you'd need to be buying and these are the types of properties. So just bringing clarity around that and making sure that what they're trying to achieve and what they think their plan is or their idea is, that they actually align.
Yeah, good. Okay. All right. Well, we've got the three. We've got three bangers. And the bank is happy to let us let us continue because perhaps we did that little uplift one, that development one's kind of sitting there and that's valing all right. And yeah, we've got the opportunity to move into 4 and 5 with a view to, Jay, I'm kind of drunk on this property investing thing, and I've read some books about retiring on $2,000 a week. I'm interested. How do we get to the next level? So what's the discussion from there from a property point of view?
It's really doing an in-depth health check on the portfolio and having then discussions with the likes of an accountant, their mortgage broker, having a round table discussion and go, well, what do they need in terms of for them to continue growing the portfolio? Is it another stronger cash flow property? Do they have the capacity to buy another kind of value add development upside one? Are they open to doing the developments and we want to kind of go down that road, or do we get another set and forget? So that's kind of where we do another health check, snapshot and have a look at, what's the next one? Which one makes most sense suited to that individual? Mm-hmm. And then the same with property number 5 as well. And then, their timeline can be a consideration as well. If the timeline's a little bit shorter at that stage, then we might want to get a value add, property we can renovate and very quickly add value or something like that. So 4 and 5 are kind of replicating one of the first 3. It's just which one kind of matches the client's strategy overall.
And people talk about matching the property to the needs of the portfolio, right? So you could have 3 properties and your broker is saying, Jay, you are absolutely tapped out. Like you need the next one to be cash, or you're not going anywhere in a hurry, or you might be in such a great yield position. They're like, why don't you just go for a real, capital growth play? Like, let's get a real blue chip one in the mix. Is that sort of normally how you inform the strategy?
Yeah, definitely. And that's why having the conversation with, mortgage broker, their accountant, sometimes their financial planner as well. So everyone's on the same page. I think that's really beneficial, because sometimes the client can start getting conflicting information, right? Because people are only looking at their own kind of area of expertise. And that's when often, we've done it plenty of times before, where we'll go sit in the accountant's office where they run around the table, or the client's office in their business, or whatever it may be, have that discussion. And it's really good, interesting to have that kind of round table. Everyone kind of puts their thoughts and preferences and whatever on the table, and then collectively we all kind of make a decision on what's the best next step for the client.
Yep. And when we talked about 4 and 5, they were resis, and then from there you snuck in commercial. Now that begs the question, well, if commercial's sort of the goal, why aren't we doing it from the beginning? And why do we want that residential base before we do go to the commercials?
Yeah, so the entry point to commercial is a lot higher. So yes, you can buy cheaper stuff, but typically kind of bare minimum, we recommend about 1.2 million. But, a lot of the commercial stuff we're buying might be 2, 3, 4, 5, 10, upwards of that. So to get a really good commercial property, you definitely need a higher amount. And if you don't have that cash or equity to start off with, we need to build that. We need to build that base.
Yep. There'll be just quickly, there'd be people listening that go, well, no, that's not true, because I saw on this Facebook post this person bought a warehouse for 330. So, there's deals out there, Jay. What are you talking about?
Yeah, and you can also buy residential properties at like 50, 60 grand if you go somewhere super remote and regional. Doesn't mean it's a good asset. My view always is, if I wouldn't put my own money into something like that, I'm never going to recommend it. One of the key things with commercial property is, the lease itself and the tenant are extremely, extremely important, way more than residential. So getting a tenant that's got strong financial backing, a good tenant themselves in a good industry, once you start ticking all those boxes, you naturally get to a higher price point. So, we will never do anything like restaurants, cafes, small little industrial sheds with a karate school or any of that kind of stuff. Our focus is really a lot in healthcare. So medical centers, pathology labs, allied health, oncology, dental practices, vets, stuff like that.
They all sound very recession proof.
Yeah. And, if you take, let's say, a medical center as an example, they're very geographically bound to that location. They're anchored to that location, because if the medical center picks up and moves from one suburb to a suburb 15, 20 minutes away, they might lose 95% of their client base. Yeah. If it was an accounting firm and they picked up and moved, they'd probably retain 95% of their client base.
Yep.
So they're very much anchored into that location. And then you've obviously got the fit out costs, stuff like that. And then when you get a little bit more deeper into it, you can have a look at things like how the business is actually structured in a medical center. And it might be like 6 or 8 doctors part own the business itself. And then part of their own succession plan is when they retire, they bring in a younger GP or doctor that they'll look at selling their share of the business to. So it stays in the location for quite some time. Long leases, the tenants themselves are all high income earners. So there's a lot of kind of stability around that. And obviously the growing need and demand for healthcare. Outside of that, we look at childcare. That's a really fascinating sector. Heap of kind of government support. I think almost anyone you speak to anywhere in the country knows how hard it is to get into a childcare center. They're often wait lists and they fill up before the things are even built. So that's an interesting sector. And then motels as well, which is kind of what my family's background is. And that's what we kind of our little niche and what we specialize in.
Well, speaking of that niche and commercial more broadly, we're going to cut this into a two-parter. And the second part of this, we are going to focus specifically on, okay, we've got the 3, the 4, the 5. We're in a position where we are chasing the commercial. But before we do that, I just kind of want to ask, well, what is it about the portfolio that we've got to date that enables us to get into that commercial? Because you're sort of talking about an entry point of 1.2 and above. Is it the expectation that the equity would have grown to a particular point, or the cash flow has to be X, or do we need some sort of savings? Or, you often hear about these brokers that are saying, well, the loan is actually based on the deal and you're not even important to it. So if the numbers stack, you can actually borrow money for the commercial in and of itself. How does it happen?
Yeah, it's going to be very specific to each individual client, what their budget is, what their savings are, what their serviceability is like, the asset value and the income from the existing portfolio. There's a lot of moving parts into that. But I think very generally speaking, we're trying to build that resi base, get the capital growth, and then extract that kind of capital uplift and putting it into commercial to then get the strong passive income.
Yep.
Which then, like we were talking about before, can then feed into, servicing more debt. If you wanted to keep growing the portfolio, it can pay down the debt, or it can provide the passive income that you need, as you wanted to transition into retirement or whatever that may look like.
So assuming this portfolio has, let's say, an average yield across the whole thing at a 5%, what sort of equity amount would we need to start playing in that, $1 million plus space from a commercial point of view? Like, are we talking we need 300, 500, and over what period of time is sort of reasonable? I know it very much depends on the situation, and let's just assume you've put an enormous disclaimer in here because there are so many variables, but give us some broad numbers.
Well, so for commercial property, it's depending on the type of property and where it's located and the deal itself and all the rest of it. But typically you'll need, 20 to 30% deposit. So part of what we'll do is when we're mapping out a client's portfolio is going, well, if we were to get into a 1.2 or a 2 or a $2.5 million commercial property in, 7 years time or 10 years time, what does the existing portfolio need to do in order to get there? Is that realistic? And when will we hit that point in time?
Yep.
And it's starting to get some visibility and clarity around timing and what it needs to be done. And is it possible, or, can it happen sooner? What if we brought that commercial property in sooner? How would that change the outcome as we look forward? And that's kind of really kind of a key part of that portfolio planning stage.
Yeah. And we hear a lot about investors that bought their first property when they were 18, or they've got 5 by the time they're 25. And of course it gets silly. It's like 100 by 30, or, 10 properties in 10 minutes. But I heard someone ask you recently, Jay, like I'm in my late 30s, I'm in my late 40s. Is it too late? What would you say to people that are wanting to sort of really go down the path of what you've described here? What sort of time horizon does one need?
Definitely don't think it's too late. It's just more, there's a different approach, maybe a different, the strategy maybe changes slightly. If you're, let's say, mid 50s and buying an investment property, what we'll be looking at, where and why, is going to be different to if you were, 19 and, wanting to build a portfolio of 10, 20 properties versus someone that only wants 2 or 3. The approach is going to be very, very different. So it's definitely going to be tailored to the individual. And then timelines change as well. That mid 40-year-old, whatever, the income is going to be, presumably a lot higher than someone a lot younger. That might mean they might be able to go a little bit more aggressive over a shorter time frame. There's a number of different variables, but it's definitely tailored to kind of each individual rather than being a blanket stamp. Hey, this is what you need to do, and this applies to everyone.
Beautiful. Well, you've given us a a fantastic roadmap and really kind of broken it down in quite simple terms about what path you would take to get to a point where you're really putting yourself in the game to be able to start looking at properties that give you that cash flow. So thank you for sharing that, and I look forward to jumping into episode 2.
Looking forward to it. Thank you.
Cheers.